Hey everyone, and thanks for jumping back into the Cryptoverse. Today, we're going to continue our collaboration series. We have a guest, TXMC. He runs a YouTube channel called Alpha Beta Soup. He also has a Twitter account. I will link both of those in the description below and in the pinned comments. So make sure you go follow him and subscribe to him on YouTube. It's a pleasure to have you here, TX, and I look forward to hearing your outlook on Bitcoin.
Thanks for having me, Ben. Looking forward to chatting with you.
Sure. So, when I generally bring people on, one of the first questions I ask is, what is your outlook on Bitcoin right now? Not necessarily on like hourly or daily timeframes, but in general, medium-term timeframes, long-term timeframes. What's your outlook right now, and why do you believe that?
Sure. Yeah, I'm glad you ask it that way because I don't really pay much attention to hourly and daily timeframes that much, and I think right now Bitcoin is kind of along for the ride with the bigger picture of macro, and so it's kind of hard to have an opinion about what Bitcoin's going to do over the next 3, 6, 12 months without also having an opinion about what the rest of the economy is going to do, and that's kind of an unavoidable fact. So right now, my opinion about what's going on with Bitcoin is that it's getting punched in the nose like all risk assets. Even though it has anti-debasement properties, sound money, all that, it's treated like a risk asset. And right now, with tightening monetary conditions, possible recession, debt concerns, it's not at a place where there's a strong appetite for it. And so I think that it's kind of where it is now as a result of a lot of unsecured debt and poorly allocated capital that needed to get wrung out. That's why we're down here below the 2018 all-time high or bouncing around near it. And I think really we're just we're stuck in this mode now for a while until we get a sense that the people in charge of the money are going to start to change their policies, which will make things like risk more appealing to investors.
Okay, so you're generally just in the camp that like it's basically just going to remain correlated, right, with other risk assets for the most
Yeah,
part. And until the
it
Fed
will.
until the Fed pivots, or at least is the pivot is in sight, where we shouldn't really
Right.
expect a whole lot of deviation.
And it's silly, right, that we have to wait for that. But that's the reality of it, unfortunately.
One follow up question I have to that, because I actually wholeheartedly agree with your sentiment and outlook on that. But one question I have, and I like to get everyone's opinion on, is a lot of people say that, and a lot of people are in that sort of camp. Do you think, we also have this Bitcoin halving out in 2024, which is typically generates some interest in crypto. Do you think that's enough time for sort of the macro to start looking better? Like, what happens if we get to a Bitcoin halving and the macro still looks bad? So I guess the question is twofold. Do you think that the rest of 2022 and 2023? Do you think it's enough time for us to see the Fed start to pivot they're from their and go from QT back to QE, or if it's not long enough, how does that affect things after the next Bitcoin halving?
Yeah, that's a good question. And one of the contexts my mind goes to when I think of the halving is that the prior three halvings all occurred in the secular bull market, right? And so if hypothetically we were still in current conditions or potentially worse, in middle 2024 when the halving occurs, I wouldn't expect it to have the same effect that it had the previous three times. I think it could generate some interest, some idiosyncratic interest to Bitcoin because the halving is a unique event specific to Bitcoin. So I think that yes, it could create some interest. But to answer the first part of your question, like, do I think that that's enough time? I do. And the reason I think it's enough time is because I don't think that they can tighten for another year and a half. The debt situation does not allow them that kind of flexibility, in my opinion. And I think that sometime, if I had to completely speculate, certainly no one knows, but I would speculate that within the next year, they will already be beginning to cut rates or have serious talks publicly about how they're planning to cut rates. Because I don't think that they can carry this on for another year, 18 months, 2 years, which I was tweeting about recently. So I think to answer that part of the question, I don't think that this current situation and the current outlook by the Fed and all that is going to be able to last until 2024. I think that we would probably incur some much more severe economic damage if that was the case. But I also think, in some degree, I think the halvings going forward will have less of an effect because we have 90% of the supply that's out there. Future halvings are diminishing issuance on already just a smaller portion of that supply. So I think that there's some kind of diminishing returns in that regard. And maybe the hype kind of drives it more than the fundamentals of what the halving is doing potentially. So that's kind of my total thoughts on that. Obviously, like a year and a half from now, it seems like an eternity. 2 years from now seems like an eternity. But yeah, there's probably a lot that will change between now and then.
Yeah, for sure. One of the interesting things too is kind of comparing this to the dot-com bubble. I know that's kind of been a popular comparison and kind of seeing what happened back in 2000. And I believe it took a couple years for, the market to really unravel. So, and even with a couple years, you would still see the bottom before the next Bitcoin halving. It sort of begs the question though, like if, let's suppose we are either, I mean, I agree with you. Like, I don't think the Fed can tighten for the next 2 years. It'd be very, very detrimental if they did. But they could tighten for of course, many more months right now. If we are, let's suppose we are in an environment where, we're not necessarily in a secular bull market, but maybe the Fed has softened up a bit. Do you see a scenario where Bitcoin could have a bull run? But it's unable to put in a new all-time high, depending on the macroeconomic conditions of the time, like where it goes from 15K or 10 or 15K, and it goes up to like let's say 50K or something, and rather than putting in a new all-time high, it just kind of gets cut off there. For whatever reason. Do you think that is a realistic possibility, or do you think it's much more realistic that Bitcoin would put in a new all-time high?
That's a good question. That scenario is basically a retrace rally, right? And often in a bear, when you get those retraces, you get the fall and then it bounces. But at the same time, though, when you look at the dot-com bubble, or even if you look at the 2018 bear for Bitcoin, those retraces, those strong bounces in the bearish part of the market, they came after a swift fall, right? When there's still like energy in the market, it's almost like a ricochet. But for us to generate that kind of a rally from here, like something would have to catalyze new momentum into Bitcoin, right? Like I find that the energy in the market has kind of been sucked out, right? And so for us to get all the way back up to 50, I feel like a few things would have to start loosening up. But I do think it's possible. And I think, until we got to a place where we were actually in a flowing liquidity kind of QE style market again, I don't think all-time highs and price discovery could be sustained, especially when you think about this environment we're in with higher costs, right? Like all previous instances of QE have come with inflation under 2%. So we are in a vastly different environment now. The things that people have to pay to survive, like hierarchy of needs things, shelter, food, fuel, like in some cases debt, like those things are vastly more expensive as a portion of their budgets than they were the last time we turned on QE or any of the previous times. And at any other point in Bitcoin's history, right? It's worse now. So I think that those are factors that are hard to make direct comparisons to maybe past bear markets or other times we've seen QE, because there's a difference in the fundamental costs for consumers and investors and in the ways that they allocate their cash. And so I think that because of that, like even if we go back to QE, if we're still in an elevated inflation environment, I don't 100% know that the response to QE looks like March of 2020, where basically it put in the Pico bottom and we just went straight up from there. Bitcoin 20x'd from there. I don't know that that's what we get. Maybe because there's so much debt, because costs remain sticky, maybe it's more of a choppy kind of like what it looked like after the great financial crisis for a while. It was just kind of sideways. We couldn't quite make new highs until several years later. it could be something like that, which is fits with your scenario.
And you talked about inflation, and one of the things I've noticed and I've talked about a little bit on my channel is if you go back to the 40s and the 70s, we had periods of high inflation. We basically had an inflationary decade in the 40s and in the 70s. And obviously the 40s, we had the war. Um, you could argue that I suppose that after the pandemic or sorry like during the all the printing of the pandemic, it sort of mirrored what it might look like in a war, even though it's
Like a
not.
wartime economy.
Right, exactly. And we're paying the price for it now. Do you think that let me ask you this. Is there a scenario in your mind that could exist where the Fed pivots and inflation is still at 9% year over year? Like do you see something like that happening? Because if something like that happens, I believe it would be very different from anything we've ever really experienced before, where we're just like, we're keeping the money printers going and inflation is still sky high. Is that something that we're just going to have to get used to? Or what do you think about that?
I think that's a real possibility, Ben. And when you think about the history of human societies with fiat money, there's only really one outcome. It's pretty binary,
Mm-hmm.
and there's a point where the markets will not sustain tighter conditions, right? Like the debt-based system must expand or die. The existing debt must be refinanced in an ongoing basis to maintain, good standing. And I think that they run into a place in the future, sometime in the next year or so, if they continue to tighten without really softening in any way, where there could be a blowout in unemployment. The treasury markets could become illiquid like they were in March. And if that happens, if let's use the treasury markets, for example, that's what turned them in March of 2020, right? Like the treasury market must stay functioning, and it's already seeing really weird liquidity. Like if you look at the move index, it's spiking really high. It's almost up to where it was in 2020. It's past where it was in 2018. It looks really ugly. If that were to happen, if something cataclysmic were to break and force them to soften, they'll do it even if inflation hasn't been defeated. And my thesis is that I believe they're praying to Christ that inflation comes down before they get to that point. They've stated
Right.
they can't do much about it. You probably know it's mostly supply driven at this point. It's supply
Right.
constraints. And so their policies are sledgehammers. They're not scalpels. And there's very little they can do about the supply constraints that are causing prices to go up. So I think that they're just hoping to God that they can tighten, build up a little bit of cushion, because they can't go into a recession with zero rates, right? You've got to have a couple of bullets in the gun to be able to soften conditions. So there's definitely a scenario, not one that anyone wants, where something breaks that is too severe for them to ignore, and they have to return liquidity to the markets, regardless of where inflation is. And if that's the case, to your point, it probably sticks around for a while. And then it just becomes a race of the clock at that point, where you're trying to give people dollars quickly enough that they can pay off their obligations and buy their goods and things. That's where hyperinflation becomes more realistic. That term gets used a lot incorrectly. We're nowhere near that, but that it becomes more realistic if we actually enter that scenario.
I have a couple of questions that sort of pop up from that sort of train of thought. The first question is, the Fed raised 75 basis points last month. I
Yeah,
believe 50 the month before that. Um, and, obviously, I think markets are already starting to price in a 100 basis point hike,
it's that way.
potentially this month. Where do you ultimately see them being able to go without breaking something? Because at this rate, I think back to the beginning of the year when I remember a lot of people saying they could never go to 3% or something because it would absolutely break everything. And
Mhm.
we're only a month or two potentially away from them to getting from those levels if they continue hiking at the rate that they are. So, but at the same time, inflation's going higher, right? It's
Right.
8.6 last month, 8 point or 9.1 this month, and
Right.
so it seems likely that they're going to continue raising rates. But do you see it? Do you see them sort of continuing to raise rates, but maybe the rate starts to go back down? Like, do you see that happening relatively soon? how high do you think they can realistically go without breaking something, as you said?
That's the $1 million question, I think. I've tried to do some modeling of this recently. If you look where the 2 year is, it's a little over 3%. It's like 3.1. And in the past, when the 2 year, when the Fed fund rate touches the 2 year, that's usually the end of the hikes. That was the case in 2018. The Fed fund rate got ahead of the 2 year, and that was it. That was lights out. Same thing happened in the cycle before that. I think that that's a decent barometer for where they could get to. And, if you look at the bond market, I'm certainly not a bond expert, but if you just look at where the yields are, they're having trouble pricing in much more than 3%. Like they just can't seem to get themselves there, no matter how much the Fed screams that they want 3.5, 3.8, whatever the numbers are they're throwing around. The bond market can't get there. The 2 year just seems to not want to be able to get there because in part, it's because of the debt load, right? And so when I was trying to do some modeling, maybe I'll share my screen here if I can find my yeah, here we go. I can find my chart. I'll share a chart for you real quick here that shows and kind of encapsulates what I'm talking about. So can you see my screen here?
Let me see. Yeah, I can. Yeah, it looks like, yeah, I can
Bunch
see
of
it.
lines.
Yeah, the rates as debt payments.
Yes. So this was a model I was trying to run, and I saw someone else posted one similarly on Twitter the other day. Basically, this is the federal funds rate, this thick line multiplied by the public debt. And so it's just a simplified model to try to show interest payments on the public debt if they were paid in the rate of Fed funds.
Okay.
And the interesting thing over time is that this is kind of the opposite of what the Fed funds rate looks like when you don't run this model, right? Like it's putting in lower highs cycle by cycle, but when you do it this way, it's putting in higher highs with the same kind of trend line. So there's a little bit of a confluence there. Like if I show you, this is the federal funds rate down here at the bottom.
Right.
Up at the top's the model we were just looking at. Here's the federal funds rate. So you can see it's putting in lower highs with each cycle as the debt, which is in orange, continues to rise. But when we multiply it by the debt, it's also following a similar kind of trend line, right? And these other lines here are simulated rates. They're just hypothetical interest rates as a percentage of the debt. And if we just kind of follow the historical trend, again, this is super simplified. This is not the way debt is actually paid, but it's just kind of a way of showing the relationship between the rates and the amount of debt in the system. And if you kind of see the way it is topped out, if we were just kind of follow this trend, it looks like a newer high would be right in this area. Well, these simulated rates here, these three colors, are 2%, 2.25% rates, 2.5% rates. And they simulate a cost, right? They simulate what the interest payment on the debt would be if all of the rates of all of our public debt were that value, if they actually got up to 2%. It would cost about $600 billion. Well, that's not the interest rate of all the debt. The interest rate on all the debt's closer to like 1.6. But as we raise rates, it puts upward pressure on all of the interest rates that compose the public debt, right? So over time, that cost continues to rise. But the reason I'm showing this model really is just as a frame of reference here, that if we're kind of looking at this long-term trend here, and it seems like somewhere in this region is about where it would probably run out of steam, this coincides with rates around 2.5%, maybe 3%, but that starts to look a little ridiculous. That starts to get into the $800-900 billion interest payment realm, which is more than we pay for our annual defense budget. So like there's a real cost to maintaining the debt in good standing and not defaulting on it, which would trigger greater economic calamity. So they have to pay these costs. And I think that this is one of the facets that I don't see talked about enough when I hear folks talking about the tightening of conditions, how they need to get rates to XYZ number because we've got to return to normalcy or whatever tradfi people say. I think that there's a serious ceiling on it. And just based on this, again, very simple model, it would suggest that we're very close to that ceiling and that another maybe this value down here is it's actually about up here right now. This is an older chart. It's actually about right up here. But another couple of hikes, we're going to be right up here. We're going to be right near this line, which represents a 2% rate. So I just wanted to show that kind of, this is how I think about it.
Well, I mean, it sort of goes. I see what you're saying, though. It's like I can understand. Like they're basically really hoping that inflation starts to come back down because something's going to break sooner rather than later. So if it starts to come
Right.
back down, at least they could rationalize it a bit more. If it's not coming back down, then we're going into a completely different environment where you could experience QE where inflation is still sky high. But I guess that brings up another question, and kind of going back to Bitcoin really, and
Sure.
every market cycle that I've experienced for Bitcoin, there's always a new narrative, right, as to what it is and why does it have value, whether it's a store of value, whether it's an inflation hedge, whether it's a peer-to-peer currency, right? There's always something, and people are always trying to figure out like what is the inherent value, what is it going to be, and as the last couple of years, as I'm sure you experienced, a lot of people talked about as an inflation hedge, and during, I feel it seems like when inflation was at fairly normal areas, 2%, 3%, whatever, Bitcoin was actually doing quite well. But it was when we got up to this, this much higher range, like 5, 6, 7%. And I remember distinctly in November when they came out and said inflation was just putting in these record high numbers, and that sort of marked that local top for Bitcoin at 69K. I remember that, and I guess I wonder what happens to Bitcoin during a phase where we go into this completely new um, uh, regime or new scenario where you have not only do you have QE, but you also have inflation soaring. Because I mean, as you said, the Fed can only do so much. They can't control supply constraints. They don't have nothing to do with that. I mean, even there, he was even Powell was even questioned about that. It's like you can't do anything about the supply side. What they can do, I guess, is they can try to curb demand, which would then put less pressure on the supply side. But how would Bitcoin? How do you think it would perform in that type of environment? Because we know with very high inflation, it's not done so great, right? Like it hasn't really been doing
Right.
that great. And when we had low inflation and QE, it did really well. And I mean, even throughout the entire decade, you go back to 2009, 2010, all the way through. I mean, this has just been one big cycle, and I mean, it's been a secular bull market for the last decade. But supposing that we go into a period of very specific QE and high inflation, that's two separate things that we haven't really experienced together. Do you think Bitcoin's performance during that time would be better than it has been for the last 6 months? Worse than it has been for the last 6 months? What does your gut tell you about that type of environment for Bitcoin?
My gut says that it would be worse. So the thing about the inflation hedge narrative is that it's wildly misused. So Bitcoin is not a hedge against price inflation. It has never been, and it never will be, as long as things are denominated in USD, right, or not Bitcoin. When it's not the denominator, it isn't protecting your buying power. It's just another asset denominated in USD. It's just another numerator. And when the denominator is strong, the numerator is weak. I think that what it is a hedge against is monetary debasement. Again, when things are denominated in Bitcoin, it will preserve your buying power. And I think outside of scenarios where commerce is denominated in BTC, it really thrives on liquidity. And that's why it ran in March of 2020 with everything else. And that's why it is now suffering under a shrinking monetary supply and tightening conditions. Because if you really think about it, the shrinking of the fiat money supply weakens the value prop of Bitcoin, which is anti-debasement. We are now currently doing the opposite of debasing the currency, right? So as long as the money supply is shrinking, I'm a Bitcoiner. I still own Bitcoin. I think it has long-term potential. But if I'm just speaking realistically, when they're going through QT, that weakens some of the value proposition of Bitcoin for people that need dollars, right? So I think that that's why it experiences these things. If you look at the 2018 and 19, when we had the last time we had substantial QT, Bitcoin suffered. When they first began QT, it was before we reached the peak in 2017. But if you look at the pace of it, it was really small. Like they started it as a trickle. It was almost nothing. Mm-hmm. And it really picked up its pace in early 2018. And that was around the time that Bitcoin was in a bear market. Equities started to roll over and soften a little bit. Bitcoin responds to QT and QE. Like everything else, despite what maxis want to believe, it's not hedging you against inflation. People didn't run to Bitcoin in March of 2020 because they saw the future and they knew that there was going to be price increases. They ran to it because debt became cheap and they flooded the system with liquidity, right? And so money seeks out yield everywhere except for dollars because the opportunity cost of sitting in cash is simply too high in that environment. So I think that's my response to it being an inflation hedge. I think if we get in an environment where they have QE again, uh, it's possible that QE looks different, right? Like in March of 2020, they literally threw the kitchen sink at the economy. They bought everything at indiscriminate amounts. They did helicopter money. They flooded the system. They were buying corporate equities, like corporate bonds, everything. So I think that it's possible because of the situation we're in, because the debt is so high, because now we have this price inflation problem, that potentially whatever QE comes next could be more targeted. It might not be such like a carpet bombing of liquidity. They might try to say everyone at certain income levels, you get this much money in your bank account for gas, you get this much money for you can spend on these particular items, that kind of price control, central planning, big brother kind of stuff, I think is very possible. And that means that risk assets of Bitcoin's ilk, which is the way it's treated, may perform differently. It may not look the same. Kind of like we were talking earlier on the call, maybe it's more of like a boxed in range, struggling to find new highs, or at least to sustain upward movement, because there's so much other sludge in the system that they can't get the debt down enough. And when they turn QE back on with high prices, they're chasing the inflation at all times. So I think it's much different from the last times we've had QE in those low inflation environments that allowed people to spend that money on Bitcoin. If everything else is more expensive, there's less available capital to go to crypto. It's
Right.
going to go to food and fuel and shelter, et cetera.
So like everything else, it ultimately just comes back to don't fight the Fed, right? Don't fight.
Yeah.
Yeah, I mean, sometimes we of course we have all these sorts of indicators and whatnot, but at the end of the day, we just don't fight the Fed. Um,
Right now,
right?
right?
Yeah,
I
yeah,
think
yeah, yeah.
the thing I'll add is like maybe in the future, I think that there's a possibility it, further down the line, years from now, where Bitcoin is larger, enough people understand it, it's got enough adoption that maybe it's able to do slightly more, unique things. But right now, it's highly correlated to everything else.
I know you have some background in looking at on-chain charts for Bitcoin,
Yeah.
and I occasionally put on my on-chain analysis hat. Um, some things that I've looked at over the last few months and I've been tracking are things I'm sure you're extremely familiar with, like the MVRVZ score, the Peel multiple, all these sorts of things. You even have the hash ribbons, um,
Mhm.
the terminal price, the balance price, all these things. And some of the ones that are historically fairly good at finding a Bitcoin bottom, like a macro bottom or a market cycle bottom, if you believe in the idea of Bitcoin market cycles, right? Like the idea that you'll see this macro bottom, and then we sort of slowly build off of that going into the next bull run. I've looked at a lot of these on-chain indicators, and it seems to me that some of them are not necessarily convincingly bottomed compared to where they were in prior cycles, but they're getting pretty close, right? Like they're not like it seems like we're really really close, or if we had like say one more leg down, we would be in that same range as prior market cycles where you have like an 80 to 85% drop or something from the prior all-time high. You see the MVRVZ score fully reset, you see the Peel multiple fully reset, you see the supply and profit and loss fully reset. The question I have is, are you seeing that same type of stuff? Are there any on-chain indicators that suggest we've already bottomed or that we have a long way to go? But then the other sort of the follow-up question to that is, does it like how important is it if we are still in a period of QT, right? Like so if what happens if every on-chain analysis known to man bottoms, but the Fed is still raising interest rates and inflation's still high, And how much does it matter in that type of environment? So I guess first answer, like I prefer the first answer to be about the actual indicators, like what are you looking at? And then the second one is what happens if everything has bottomed and we're still the Fed remains hawkish.
Yeah, that's a good questions. Yeah, on-chain is going through its own kind of maturation here over the last 6-9 months. There's been a referendum on it. I think that some of it's fair, some of it's not fair. I've looked at on-chain a lot, and there's certainly parts of the last year that I've gotten very wrong. And when I look back at them, I see ways that I could learn from it. And I think the thing about on-chain and a lot of these metrics we use, a lot of these oscillators, if you think about what on-chain metrics are doing, they're simply measuring a ledger of transactions. Party A sends Bitcoin to party B. That's all that's going on. And we're measuring this over time. We're extrapolating all of these complicated behaviors onto a very simple thing. And over time, because of the first 10, 12 years of Bitcoin's life, since it existed in that pretty much nonstop secular bull, there was brief interruptions, and because it was growing from basically zero, I think that it created these oscillations in price, and we use those to create all these metrics. But unfortunately, those metrics are reliant upon conditions continuing in the same way that they were for the first 10, 12 years when we created the extremes of these values that we consider overpriced, underpriced, overvalued, undervalued, whatever. So I think that, as we go into a new economic climate, it certainly makes sense that some of these maybe are bottoming even more than they used to. It's like if you look at entity adjusted dormancy flow, which is a ratio of market cap to the annualized cost of spending. It's like a way of testing if the market is, overheated or undervalued. That metric has bottomed below all previous bear markets going back to 2010, when price first began.
Right.
And a lot of these metrics really, they're ratios of ledger activity over two different time periods, right? Like short-term spending compared to the last year of spending or something like that. And so you can get these periods where everything gets really quiet. And if it's even a little bit quieter than it was before, a lot of these metrics bottom really hard because they're all measuring the same thing ultimately. Right. They're all just measuring the volume of transactions at the end of the day. So I think that we can use them to identify value, certainly, to identify extremes of ranges, historical anomalies, deviations. But they could all stay very bottomed for as long as it takes for interest to come back. Just because the MVRV hits the little green box at the bottom of the Glassnode chart, or entity adjusted dormancy flow, or my metric, value days destroyed, or any of these other things, just because they bottom, all that's really telling us is that the activity on the ledger that all of these metrics are measuring is considerably low compared to history. It doesn't mean that price has bottomed. It doesn't mean we must go up from here because we have gone down to the extremes. It just means that compared to where we were 6 months, a year ago in the past, interest is much lower. And so I think that that's kind of the relative way I look at on-chain. I think if we're in a trending market, it's much more useful, right? Because then you can identify divergences in activity, right? Between the narratives you're seeing, the actual technicals of the market, the volume, and all that kind of stuff. You can compare that to the cohorts on chain that are moving supply around and see, what that's meant in the past. But, in an environment like this where appetite is almost gone, and it's really just the hodlers that remain, I think that on chain, it loses a lot of effectiveness. It loses a lot of signal.
Yeah, I mean, I guess that one way that maybe it could be used is, it's certainly more attractive to take profits on Bitcoin when at least those metrics are really, really elevated. Yeah. So, it's sort of like, do you...
the DCA when they're bottomed.
Right, exactly. But also to recognize that even if they've technically bottomed, it doesn't mean that there can't be some uncertainty in that bottom. And yeah, I mean, I think this is the important thing.
And those narratives are very lacking in nuance on Twitter. Sorry to cut you off there. A lot of people that share on chain, they share it without that nuance. They just say, oh, dormancy flows at an all-time low. This is it. Buy Bitcoin now, and it's like, okay, but let's just make sure we understand that this is not predicting anything about the future. It's just comparing now to the past.
Well, I mean, additionally, even if you look at things like the MVRVZ or the Peel multiple or whatever it is, I mean, a lot of times they'll stay low for a year or more before they actually go back up. This wouldn't be the first time, that they would do that, and it probably certainly won't be the last. So I certainly agree with you on that. That I mean, it makes sense to use them, but don't it doesn't make sense to just bet the family farm because some on-chain metric has bottomed.
Right. You see a bunch of them bottoming at the same time. Maybe that means that we're in a good value zone. Like
Right.
everything, we're below the realized price, MVRVs at the bottom, Puel multiples at the bottom, et cetera, et cetera. Maybe if you have a long-term thesis, you start scaling in slowly, but you understand that these metrics are not calling bottom, they're calling value.
Yeah, I don't really know how much experience you have with the altcoin market, and I don't really want to specifically talk about any specific altcoin. But one thing I'm curious about. Do you have any thoughts on it? It's something I follow a lot. Is the Bitcoin dominance? Do you think it's a relevant metric at all? Obviously, you could track it with stable coins or without stable coins, and certainly it's very different than it was back in 2018 when we were in a bear market because of how much stable coins have sort of become a larger part of the entire market
Right.
cap. In a decreasing liquidity environment like we are currently in, do you see the Bitcoin dominance heading higher, or do you think that the rest of the market has matured a bit past like the 2018 ICO scams to some projects that are potentially going to hold their value a little bit better with respect to Bitcoin? What do you see with the Bitcoin dominance over the next say 12 months or so?
Yeah, I think about this sometimes. I'll admit that it's not a primary tool that I use, but I do try to look at it and have an idea of where it is, what it's done in the past. And one thing that I get hung up on when I try to apply it in a useful way is, to me, it's a ratio with an infinite denominator, right? Like it's basically Bitcoin versus all capital that's interested in crypto.
Mm-hmm.
And that number of groups that absorb capital is always growing, but Bitcoin always stays at one. And so it's hard to compare it over time, but I do think that it's a good barometer for the flight to quality within crypto itself. And we definitely, since the beginning of the year, we've seen Bitcoin dominance rise, even though everything has been going down because alts have been getting killed harder than Bitcoin, right? They
Right.
move at a higher beta, and I think that makes sense. Uh, I know that there are traders out there, perhaps yourself is one of them, that effectively use Bitcoin dominance to make decisions, and they can do it successfully. I haven't been able to do that myself because because some of what I described, like I see it as kind of a flawed ratio. And I think that it could potentially just forever kind of go down
Mm-hmm.
while Bitcoin could continue to succeed simply as more capital comes into an ever expanding space.
Right.
But to your second comment there, like I do think that the crypto broadly has matured. I'm primarily a Bitcoiner. Like I almost never talk about other coins. I trade them occasionally, but I pretty much just buy Bitcoin. And I just haven't. I don't personally have a lot of use for that particular indicator.
I mean, I agree. I mean, I think that the dominance as a on the macro will head down. Even though Bitcoin is probably going to be like the most successful or one of the most successful, more than likely. You're comparing it to to basically everything else, right? Like where
Right.
and that's going to continue going up. So I do think I do think that makes a lot of sense. But I think you're also correct in the idea that people have that flight to safety during phases like this, and that's why you do see it temporarily go up from the beginning of the year.
Right.
Um,
Yeah,
it's
everyone piles out of alts, and they either pile
right.
back into Bitcoin or they sell the alts before they sell their Bitcoin. Because they're further out on the risk curve.
It's a brutal cycle, like the Bitcoin goes down, alts get wrecked harder, then Bitcoin usually goes up before altcoins do. Um, and then people then FOMO back into Bitcoin when it's going up, and then it peaks, and then the altcoins go up after that, right when people are FOMOing into those, and then they go down. So it's like I've seen this cycle play out so many times, but like same thing happens every single time. um, we've covered a lot, and I really do appreciate your time. But I want to ask you just one more thing. But before I do, I want everyone to make sure you go subscribe to TX. He's got a YouTube channel, Alpha Beta Soup. He also has a Twitter account, and I'll link both of those down in the description below, and we'll also pin the
Thanks.
comment as well. So make sure you go follow him. I'm sure we'll try to have him on in the future as well. But really, the last thing I want to say is I don't really have any specific question. Just do you have um, any sort of like final words for the audience? Maybe some advice on how to navigate this time. I know a lot of people sort of joined crypto for the first time in 2021, and like the people who joined in 2013 and 2017, they got wrecked in 2014 and 2018. What was your sort of like some final words in terms of getting through this bear market, or kind of trying to find what a good strategy would be during a time like this?
Yeah, I think a lot of us are in that headspace right now, trying to figure that out, and certainly this bear market has been one that has tested a lot of narratives. And, in every bull market, there are narratives that are spun up to justify price. That happens in every bull market. This one was bigger than all the previous ones. So there are more narratives to crush, right? And there's more people that have to, pay their tuition, so to speak. The market makes everyone pay a tuition. It's a different cost for every person. And this is one of those times. And, there's a lot of people that came into Bitcoin in the last year believing that it was undergoing its orange swan transformation moment where it breaks away, where countries adopt it as legal tender, where governments around the world realize that they must hedge themselves with this pristine asset, that everyone's just going to buy it forever. 30K is going to be the generational floor. Institutions are coming in. They're going to hold up price no matter what happens because Tesla bought it down here and MicroStrategy bought it down here and Square bought it down here, et cetera. And none of those things proved to be true. And when you step back after a bear and you look at what happened, you recognize that this one is really not that different from all of the prior ones. We just have different stories to tell, right? And so it can feel very doomy, can feel very doom and gloom, but we go through these cycles all the time. There are things that are different now. There's some things in the geopolitical space that are unique. Like what's going on with Russia and Ukraine, with the generationally high price inflation we're dealing with. Like those are new factors. But much of this other stuff happens over and over again, and so there's some solace to be taken in knowing that we go through this cyclically, right? That this isn't the end of the world. This isn't the collapse of all money and all society. It's just a really ugly bear market with record debt, and we're going to have to work our way through it, and it could be painful. But I do think that if you have a long-term thesis about Bitcoin as some kind of, or maybe it's crypto broadly for you, whoever's listening. For me, it's Bitcoin. And my thesis is that it will long-term be a protection of my wealth and my buying power, and that it has the potential to go up high in price. And I think that having that kind of a thesis and knowing that fiat money has a certain cycle that it follows, and it usually ends with the inflation of the currency into hyperinflation, those things are bullish for Bitcoin long-term, but they can take generations to play out. They can take decades. So people who get caught up in thinking that this is the end of fiat and that everyone's going to run into Bitcoin, I think those people will be proven wrong. But maybe I'm not answering your question, but I just think that this bear has been one that I've been thinking a lot about how this time really isn't that different. There's things about it that are different, but human society has been going through these cycles, all the way back to ancient China, where we think that we can control money at the government level, and it always gets proven wrong in some way, and society returns to hard assets ultimately. So I believe Bitcoin is a hard asset, so that's why I have a long-term thesis about it. That's why I invest in it. But we're going to have to work through some of this pain, and I don't really know what the outcome's going to be. But ultimately, because of the debt load, they will have to print again. And when they do, risk assets will probably benefit as well as anything else can benefit in that environment.
I think that's a great spot to end the interview on. I appreciate your time. Appreciate you coming on here. We'll try to bring you back on in the future to give us an update when this after this bear market is maybe run its course a bit more. Anyways, guys, if you're watching, make sure again you subscribe to this channel, subscribe to TXMC as well, and we will see you guys next time.